Hello everyone, today is December 3rd and this is session number 13 of YCAF Practicum course. As usual, we're going to discuss the bias game, we're going to talk about the anatomy of the trade. I thought, it was very interesting action yesterday. We'll have some Q&As, market update, then we'll talk about the horizontal volume, and then if we have a chance, we'll go to the exercise. In the announcements, December special is on, and again, highly recommending it because it's in line with all of everything that we've talked about. Here will be in a more systematic way, kind of like a system reveal on the long term, some of the swing trades. This is a continuation of the trilogy on the swing and intraday. And then for those of you who would like to continue, to stay with the practicum, you guys are welcome to register now. Go to our website. You have an alumni rate, and that alumni rate is also discounted right now until I think January. So anytime you register before that, you get that deep discount. And what it does is just for 15 sessions, 15 weeks, even if you're just watching the videos, but you're playing the game, you're playing the bias game, you're always thinking, you're always contemplating about your homework, and that's what's useful. So that's why we like our alumni to come back, obviously at the lower rate, and just to go through that again, because the bias game never repeats. It's always something new. All right. All right. As always, everything is for educational purposes. Let's discuss the bias game. This one was unusual because for the first time, I kind of was thinking about Thanksgiving, to spice things up. It's holidays, so how to spice this up? Well, let's have untypical chart, right? A typical chart. So PNF came to mind, and then I wanted to see how you're doing with the current bias. I wanted to show you guys the current bias from a different perspective, from the perspective of a PNF picture. And as you might know, this was the S&P, the current chart of the S&P. So I don't really have an answer for you whether this is a truly a reaccumulation or a distribution. I think that this is a reaccumulation. At least that's how I'm playing it out, even with the last 2 days reactions. Doesn't bring us any new information yet. It has to be more profound. We'll talk about this in the market update. So that was kind of like an interesting game on its own. I think that the volume and the columns that you go through are very much, a tape reading skill that you have to read that. And a lot of you just excel in that. So this is really pleasing to me because, I'm a tape reader, at my heart. I just see how the market moves, changes, and all that stuff. So, and that's what I'm teaching you guys here in this class, especially in the practicum. So this is probably one of the easiest ways, to do that. And it's kind of interesting that today we're going to talk about different type of volume representation, volume visuals. We obviously could look at the volume on the vertical bars, and that would be one representation, one visual, for us to look at the volume. We can look at the volume on the PNF. This is going to be more condensed data, so the volume signature is going to be condensed as well. We could also look, and that's what we're going to do today, and was kind of like white witching. I've prepared the slides for this session last week. Usually on Friday, Saturday, Sunday when I have a chance, I love to prepare for the whole week. So I put in the horizontal volume signature, and this is what we're going to go through today. And we're going to do a couple of exercises on this. And then Dmitry, emails me today and asking me about the price and volume. So kind of like white witching, we're going to do this today. We're going to go through that material. That's the third way of how we could see the volume. Other ways of how we could see the volume, we could see the volume, let's say through the cumulative wave. David Weiss cumulative wave comes to mind. David obviously is not the originator of the idea behind cumulative volume. I mean, if you, probably the most famous cumulative volume indicator is OBV by Granville. But David looks at the cumulative wave as a function of a swing. So, and that's a really good innovation right there. And again, not something that has not been done before. And then also, we want to look at the volume in other different ways. We could look at the up and down volume for each bar. And I think that's probably the most telling information, but it could be most confusing. So for now, we're just going to concentrate on three, right? So vertical, PNF volume, and horizontal. And that should be enough because you would be able to judge the action, from the volume and price signature. And if we would look at this whole picture here and we would start, drawing our Wyckoff story, we definitely would start with the huge uptrend that is going on. There is some kind of climactic run. We see that after this point, the price stops, goes into the trading range. So an obvious buying climax, automatic reaction, several tests as upthrusts, area where we have consolidation after the volatility. So this is like a testing ground, absorption for what? For the next rally that materializes into the upthrust. That upthrust brings a lot of supply into the end of the rally. And please note that the rally is of different quality than the previous rally. So less demand, definitely not committing significantly above, and then quickly coming back into the range on relatively modest, selling, but a lot of supply came on the last push to the upside. And then we don't see a lot of activity here until we go into the shakeout action. And then that shakeout is being resolved really quickly with the momentum rally that is confirmed also by the increased demand signature. After that, a trading range, an apex structure with all of the elements that we want to see in the apex formation. Value supply produces a change of character, automatic reaction, so some kind of sign of strength, buy-in climax concluding this rally. Secondary test, phase A, and then this is probably phase C. Volume is diminishing into the apex. Some demand is coming in, some demand is coming in, and then we are breaking to the upside. So still bullish. There is really nothing here of bearishness that we could see. If you're thinking that maybe there is some kind of upsloping structure and this is an upthrust, and we had something like this in the last couple of days, right? So there is still nothing damaging yet to that picture. What would be damaging? Would be damaging to see something like this with an attempt to retest, and then with the subsequent failure below this level, right? So overcoming this level right here as well, trying to rally again and then dropping again. So, and there are some analogs that we could look at, price behaving that way. Especially the leadership could be distributed this way, on the way up. But the economy is actually stable to slightly improving, slightly moderate. So a lot of the money managers are looking at that. So earnings are kind of like hit and miss, but overall, they are sustaining the uptrend that we are in. and more importantly, consumer base, consumer spending is at the really good levels. So money managers, when they look, they're going to look at obviously economy first in general, then economy in segments, the corporate economy, consumer economy, and then look at the Fed, look at the government and the monetary policies. And obviously there, the whole tariff story is just something else. We'll talk about this in the market update, but there is really nothing here on this picture at the point of where we look at the picture, nothing bearish about this. There might be just some short-term supply that's coming in. All right, some examples of your work. I thought I want to, show some of the examples. This comes from Eric N. And I really like how Eric just goes through the explanation of all of the zones that, he has here from green, to pink to yellow and so on and so forth. So there is that continuation of the story where analysis is being done, and I would urge you, to stop here the recording and just read this analysis, which is great. Another example, this comes from Sean, and I like how there is this, comparison, constant comparison of the analogous price actions. And then again, step-by-step analysis, and it comes to a specific conclusion, which in this case was accumulation. All right, so here's my take on this bias game. My answer is accumulation. I don't know yet whether this is a correct answer or not. So that was kind of like a trick or a tricky bias game for Thanksgiving that we have or that we had. I'm gonna try to come up with something fun on Christmas as well, New Year as well, just for us to have fun. Look at the counts that we have. And I'm kind of gradually coming to a conclusion that we could have two types of rally here. We could definitely have a more of the runaway rally like we had in 99. We could have a slow running rally like we had in 95. We could also have a very moderate rally. And I think that it's prudent for us to think about the targets that are the closest. So there are a couple of targets here from the low of the shakeout into the climactic action. And that target from the line of 2350 takes us to 3525. And then the trade count that we have in the upper part of the structure brings us to the same target, 3500. So two confirming targets. This is something that, I would want us to see happening every time we, look at the target. So that's a moderate target. There is a much higher target of 5,000 that I presented in the WMD. But this is something that I want to keep kind of like between us until we get over the hump of 3,500. So we still have to see what's going to happen here. Did you guys have any thoughts, question, additional maybe thoughts on this before we go away? No? All right, great. Well, here's your next bias game. Do I dare to ask you what bias it is? How about this? I'm not going to ask you, but for those of you who are curious, go ahead, answer, but at your own risk. If you're going to, contaminate your mind, you think that you're going to do that, then, don't do that. Don't write it down. And for those of you who are answering, I still would urge you to go and do the analysis from left to right. Divide the chart into, logical segments, what you're seeing, and then, come up to the bias solution by the end of this chart. All right, great. Let's jump to the next segment. Okay, market charts. Let's look at the market. This deserves some attention. All right. So for those of you who are following us on Twitter, this is probably not going to be anything new. This bar right here had an increase of the supply that was suggestive of some kind of potential stop in action and maybe some kind of reaction. We had a little bit of the climactic run, and then by the end of the day, and that was the key, you know, how do we close? We close bullishly on the increased effort. So there is some demand behind it suggesting a rally out of this. So we want to see what kind of rally we're going to have. Well, the rally does not come to the extreme overbought condition, overcomes and overthrows in the upthrust type of manner the long-term daily resistance, which is upsloping as well, and then it produces a change of character bar. This change of character bar is the largest bar since the low of this bar in October. This is the largest reaction. So right away yesterday on Twitter, you know, as it was unfolding, I said that, you know, this change of character is going to bring a continuation. Not only did we break the trend line here, but we're also coming in on increasing supply, and we are producing the bar that is so different than anything that we've seen before. The next step for us is to judge our current bar against the analogs that would exist in the same type of context, right? So maybe like this or this. Obviously this, and I wanted to text, not to text, but to Twitter Dmitry because he was showing one of the trades based on this bias. So 1, 2, 3, okay. All right. So let me just pick another color. So we're looking at number one. Let's think for a while. Okay. Yeah, number two. This was the largest bar since this low. Number three, number four, number five. So we want to understand what kind of strength we have for this reaction, and we want to judge the extent of the possible reaction, you know, through the force that comes right away, right? So, and I wanted to say, Dmitry, because I was following that trade of yours, that you could have a scenario like this, where you are committing to the downside, supply is increasing, and then you just have absorption. I think it's a mistake just to think that once the change of character bar happens, supply increases, that's it, we're going down. There is definitely a predisposition to do that because effort increases to the downside and result is increasing. But as we know, on the emergence of the supply, there are two things that could happen. Absorption, and that would be in line with, let's say, the previous trend in the uptrend. Or there's going to be a reaction. So in this first case, we see that there is no continuation of that selling. It starts to deteriorate, and then instead of continuing to the upside, it actually reverses. So that's how quickly absorption could happen, and could have all of the elements that we're talking about, preceding this bar, and even some of the elements that go, after this bar, right? So for instance, at number 1, we have this, last climactic run, then commitment to the downside, and then some testing action. Well, let's look at number 4. We have somewhat of a exhaustion, still somewhat of a run, but into the exhaustion. Then we have the increase of the supply type of bar, and then we have the test. So the difference between these two scenarios is that we have an instant continuation of the initial bias to the downside after the test, and here we have the reversal. So you could see how, with an exception of the short-term causality in case number 4, everything else was somewhat the same. We could make an argument that there was a little bit more demand in case number 1 than in case number 4. So only those two nuances, short-term causality prior, and there is not a lot of causality right here, and then there is more demand in this bar than, let's say, in this bar right here. But everything else was the same. So looking at the current bar and judging, the effort with which the reaction starts, kind of suggests that we are going to have more or less meaningful correction. More or less meaningful correction than what? Than what we've had before. So what corrections did we have before? On the way up, here is a correction. Here is a series of corrections. Here is a correction. Here is a correction. Here is a correction. So we're definitely going to have a reaction more than that. We're probably going to have the reaction of the same magnitude that we have had, in all of this 4 instances. I'm sorry, in instance 2, 3, and 4. And we're thinking that, probably we're seeing a contraction here in reactions, and we might see that contraction again. There is enough space for us here before falling below 3,000, to have a reaction and maybe some kind of consolidation. We just hit the all-time new high. There is definitely a lot of consolidation on the profits that needs to happen. We see a lot of institutional profit taken. They are actually moving really fast, closer to the end of the year. Those positions where they feel that they have made a lot of money, they're going to take the profit off. So Apple comes to mind, just a great example of where institutions are taking profit right now, just because of such a big run-up of more than 60% for the year. So that's a big result for them. So I'm kind of expecting, or at least at the beginning of this bar yesterday during the day, there was a lot of selling coming in, and there was an expectation that that's going to continue for some time. You could see that selling on the intraday right away. And the way how to look at this is, again, you want to look at the reactions from the beginning of the rally. You want to look at the quality of the reactions, the texture. What is it about this texture that allows the trend to continue? They kind of look the same, either by the distance that they travel or the intensity of the reactions, the effort behind them. There were only a couple of spots of vulnerability, during the whole uptrend, right here and then right here. This is where the selling has occurred in more meaningful way, and we stated, just that this is, somewhat of a vulnerable place. If supply is being absorbed, then there's going to be a continuation. In both cases, we had that absorption of the supply. What's the difference in the last case? Well, look at the texture as to how the price was moving down yesterday. So right away, even on this bar, and this is just an intraday bar, on the break of that trend, that bar breaks that trend, and you're seeing a lot of supply coming in. And behind that supply, there is a news catalyst. And this news catalyst just reaped the market for the last almost 2 years and created the structure that we are in right now. This big trading range since beginning of 2018. So this is the news that is capable of, producing significant moves. Yet the economic environment is such that it reminds me a little bit of like 2017, like a beginning of 2017, when we had a lot of news about North Korea. And every time we do, and where, we still were not used to how President Trump, communicates and all of that. So something like this, where we have single events that produce some kind of abnormal volatility, but yet the background is still pretty much bullish. So I think that the strategy here, and I was in my head, I'm talking to Dmitry a lot right now because he had this volatility trade on, or at least a directional. What was the trade? I forgot, Dmitry. I mean, obviously puts to the downside, but I forgot what. What did you buy? Did you buy volatility or did you buy? Okay, let me know. But this looks like something very similar to what we've been going through. This is on a slightly different scale, but also look that these reactions are not that deep. We didn't have a deeper than 3% reaction on the run into the 2017 high. So I'm not necessarily kind of like expecting here, a clean run. It's probably going to have some kind of reactions. And then look at the last bar. Again, I don't know, Dmitry, if you kind of, looked at my message today on Twitter as something else that I was saying here. So I tweeted in expectation that you might see this. There was a demand coming in today on the intraday, and some of my positions that are usually momentum-oriented positions that misbehaved yesterday and today in the morning started to pick up and started closing all of the losses that they have had today. And you kind of see that a very strong demand comes in and picks up a lot of liquidity that is available so easily on this news. In a way, I thought that this trade was lucky. Why? Because the news cycle continued into today. And then when they announced today that, maybe it's better to postpone this issue after the election in 2020. Well, that made a lot of sense to me because now they're taking pressure off themselves for the election. This is something that they could always say during the campaign that, we're going to return to this later because, the actions, and I could suspect that, there is some play with the election deadline, from the Chinese side. That's how I would negotiate that. Probably it's easier just to eliminate this altogether and just to concentrate on the election for the current administration. So I think that in a way this issue is being taken away. I just don't know what will be the resolution in between. So I want to understand, like, what are they going to do now? Are the tariffs still staying on or not? Is this another way to negotiate or not? So I don't know. Maybe we will have a resolution. Maybe this is just a part of the negotiation. But definitely the news cycle helped this trade. yet our technical recognition came right here on this bar. And you could see that even if you open in a position somewhere here, whether you're buying volatility or you're just directionally trading this, you could definitely have a really good chunk in a very short period of time, over just 1 day. And your exit should be somewhere here. This is definitely a change of character to this reaction, and we're seeing how some demand is coming in. There is a tail. There's a lot of volume signature, no progress to the downside, a lot of volume signature, no progress to the downside, ease of movement to the upside on lower volume, suggesting that supply has been diminished, confirmation that supply is small at this point of time, and then obviously after that we're going to have some kind of momentum rally, which still has some supply stop in action, and we're in the testing period right here. So into the end of the day, we actually have seen quite a lot of bullish activity. Whether that's going to materialize somehow, we still have to see. I would say that for the bulls, the best scenario is just to keep closes above this level right here. So don't close below. If you're closing below, then most likely, you're going to kind of retest a much lower ground. But if you're staying above these levels, there's really nothing dangerous about that. We came out, sign of strength, and now if we consolidate here and then continue to the upside, or consolidate even in a much shorter duration where maybe we have like a big bar vertical absorption and then we are staying here, then we would be still in this uptrend and the price might continue going up. So demand is strong and sell-in is strong on news and on profit taking. So a very interesting market where you have to be going in and out of themes as institutions are doing the same. They're going in and out of specific themes. And obviously, the key here is just to observe, would we have a more damage here? If we do, then we definitely are going to, reconsider this whole scenario. All right. What else? So crude is also very interesting in the way that it doesn't want to go down. So the bullish call that we have had here is still on. And I was thinking, what is the tactic here for the stop losses? And I think it just depends on how you trade in this whole thing. And obviously December 3rd is going to be a big meeting. Hold on a second, it's today, right? So did they do this already? Okay, I'll have to, yeah, okay. Oil up on OPEC optimism. Okay, so they're gonna obviously announce the cut in the production, and that's why it's holding up. So the strategy here could be either hold on to your original stop loss, because we still did not really have a true breakout. There are multiple attempts to do so, and then all of them fail. But still, the trend is kind of sustainable. In the last couple of weeks, I think volatility is all related to the OPEC meeting that's unfolding. And I would say that for more aggressive traders, you don't want to commit to the downside below this level, because that would constitute a retest. I would suggest a retest of 50, 51. And I would rather probably just not participate in the move to the downside and just have even like a break even or small win. And then maybe, if this is a true phase C, to kind of reload the position here, to reestablish the position here. These are kind of like thoughts aloud. but it looks like, you know, the news are going to drive the price for the retest of 58, possibly. Um, so the suspect, you know, for me personally was this bar right here. I'm sorry, not this one, the green bar. And the reason why it was a suspect is because there was some supply that came in on this bar, was a little bit more than, let's say, those analog bars. And I thought that, you know, we're going to have some kind of stop in reaction. The price went up. So I decided to wait and see what's going to happen next. And such a drop, but no commitment to the downside. So it was a little bit of a confusing picture in this case, and we just needed to wait. And that's what I'm continuing to do. So hopefully on the news, we're going to have some kind of continuation. Any closes above 58 and especially 59 are going to be extremely bullish, but then we're going to go into the resistance of 63.60. By the way, please note how I did that. Why did I do the resistance like this, right? So 63.60. Well, I'm looking at the supply that comes at that level. So on this bar right here, and then on this bar right here. And we know that if the price goes to this level, there's going to be some kind of resistance, as, you know, some selling will happen again, as the same type of sellers are going to come and they will remember this level and they will try to sell. Okay, gold really quickly was due for some kind of pop-up. We have, you know, structural strength here on the test. We're seeing that supply is diminishing. For some reason, I'm kind of not really impressed with gold in terms of how it reacts to the upside. I don't know what it is about this. I think that my judgment is a little bit obscured with the market action itself. But I know that there are instances when both the stock market and gold can go up at the same time. So we shouldn't underestimate this. Having said this, I still have a long-term campaign in my IRA account, you know, so I'm not exiting that at all. I'm probably going to see how this whole thing is going to resolve itself. All right. All right, Francis saying that Russell 2000 showing some relative strength. Yeah, so this low compared to everything else, right? So a low, a high, a low, a low, and then a low here as well. So yeah, absolutely, you know, and we should see how that's going to unfold. You know, this very encouraging that the price does not come in below this level, but once it does, then, you know, we definitely will be talking about a different scenario. Okay, well, that's it for the market update. Let's look at some questions. This one comes from Simon. So here is that question. Was my bias deduction to the downside incorrect? Or was it correct at that moment in time and I would need just to exit based on my stop loss? Have I made some key observations? Okay. All right. How do we do this? Okay, I know how. Hi, Simon. Are you there?
Hi, Roman. I'm good, thanks. How are you?
Good, good. I'm gonna put you on the spot here. So,
Okay.
why don't you explain to us, so that we wouldn't go into all of these details. So where is the point where we have to make a decision? Which bar?
Okay. At bar B18. So just
Mhm.
where you got R3,
Mhm.
and I sort of see that there was a downslope in apex. So I sort of thought that was weakness due to the background
Mhm.
context, which is you have the falling
Yeah,
price
yeah.
and the lower lows and the lower
Right.
highs. And so I thought the breakout of B16 would have been like looked weak, and then I was waiting for
Mhm.
the retest. So B16 I deemed to be the action bar, B17 was the test, and then B18 was the confirmation, and
Mhm.
that's when I would have taken the short entry.
Right. So the first thing that catches my eye is diminished supply signature. So we are going down on this reaction, and we're diminishing in effort, and we're also diminishing in the result. The spread here is different than, let's say, spread here, or spread here. So it looks like selling is exhausting itself. Uh, but let's say that we've entered this position, then where would we get out of this position?
So Roman, just a quick question then. So on that that reaction down to B19. And this is where I probably get confused between um, a reduction in selling
Mm-hmm.
to the downside, accompanied with that volume, and an ease of movement to the downside. And I remember you saying that an ease of movement to the
Right.
downside is when
Mm-hmm.
you break through a key
Yes.
support area. And that's when I sort of thought that that broke through a key support area, which was B0, way back at the start of the left-hand side of the chart.
Mm-hmm.
So then I thought that was more of an ease of movement to the
Right.
downside.
Right. And it is, because we are going down and we still committing to the downside, and that happens on the diminished effort. So we have that element of the ease of movement. But the way how it moves, we say that it moves with ease just because there's not a lot of effort required. In comparison to the previous movements to the downside, we've seen deterioration of selling.
Yep. Okay.
So I'm not against this trade per se, right? I'm just thinking that when you go into multiple red bars here and you are initiating the position on bar number 5, red bar number 5,
Yep.
then you could see it, and even before that, so maybe like 7, bar number 7, right? So here, so you could see how selling deteriorates. We had big spread, and then on the breakout, that spread diminishes, it diminishes more. Yes, we're committing to the downside. Yes, there is this ease of movement in terms of the effort being lower and the price still commits to the downside. But we have to compare it to the previous price actions, and we've seen deterioration. And please note that we still have a lower low here after that. So it's not like we're done with selling. I think that what if we're missing the character here, and let's say that we've entered, Simon, how would we get out of this position on which bar?
I would have put the stop loss back up towards where B15 high is. So it wouldn't be for quite a while.
Okay.
If it was to go against our initial short position to the
Mm-hmm.
downside,
Yeah. So
um,
okay. So that's initial stop loss, and where is the exit?
I think it would be on the B25 bar.
Yeah, somewhere here in this area, and even the bar before, because you have B23 that commits below the support, and then it quickly comes back into the trading range, and that's on the background where you had a downtrend, you're in the oversold, and your volume is diminishing, now the price still goes down, which creates the divergence. And that suggests a different behavior, suggests some kind of rally. And B25 is the first bar where, and you could see this from the momentum, the volume comes right here, but yet there is no progress to the upside. So result to the upside is diminished. And yet, you know, it actually almost commits to the upside. And then on the third attempt, we see that it doesn't require as much volume signature to move the price in a much better way. So there is, first of all, synchronicity between effort and the result. I'm sorry, effort is decreasing, well, not even synchronicity. I can't even say that this is synchronicity. This is more that concept that we've discussed in the November special, the ease of movement, where, you know, the effort that is required to move the price in a much better way is less than on the previous rallies. So, and that's what we are looking for. This is the timing tool for us when we observe this type of behavior out of this type of conditions, that the rally is done.
Yeah.
I'm sorry, the downtrend is done, yeah.
So what you're indicating is that prior to B25, there had been some absorption of the supply already, and that allowed that ease of movement to occur.
Yes, so when we are judging the movement, we have to judge, you know, the whole story, right? So we can't just take one piece and out of the context create the story about that. So we are kind of seeing that the story develops into the condition that suggests an oversold condition and exhausted supply. And then from there, series of tests, and we see further deterioration, non-progress to the downside, and then B25, that's going to be, you know, the area where we see a true reversal. Now the effort moves the price to the upside rather than to the downside. But obviously a lot of preconditions, you know, before that happens.
Right. And when you say that it's moved into an oversold condition, how do you identify the oversold condition? Is that via your trend channels?
You could use the trend channels just visually. Let's say if I'm looking at this whole chart, where would I have, let's say, overbought conditions? Probably here, right? Because these are the moments when the price rallies. And on any type of, let's say, momentum indicator, we're going to have those spikes. And then, so definitely this would be considered by us an overbought condition, where, you know, just visually would we have oversold condition when the price goes down, and then we are going to be in those oversold conditions, especially short term when there are, you know, big moves like this. You know, the indicators are going to move really fast, and then just visually, without not thinking about the indicators, but visually these are going to be the times where you know, the price will be close to the resistance or to the support, and therefore will be oversold and overbought. But also just think about the downtrend. By the end of the downtrend, we definitely going to be in some kind of oversold condition, either short term or long term.
Right, cool.
Okay. All right, well, Simon, thank you. That was great.
Thank you, Roman.
All right, let's go to the next segment, anatomy of the trade. Yeah, let's look at this. And I'm really curious as to what you guys are going to say. And this is going to be a poll, not going to be a poll, you know, that I'm going to post, but I want you guys to vote and tell me what you think we should do now. So currently we are in this position as a class, right? So the position was originated on this bar. what do we do here, guys? Let's vote. Let's just vote to exit, and we could exit either as of yesterday or as of today. As of today, even better. You could exit, you could add to the position, you could stay in the position, keep the position. So what's your verdict here? What do you think? All right. All right. So majority of you are staying in the position, holding, keeping it. There is one exit here, and I think that, you know, the way how this last 2 days unfolded, and especially for the technology, I think the money managers who move the market are kind of a little bit trigger fearful, not trigger happy, but trigger fearful in the way that they want to sell any of their positions that had big, quick run-ups and good profit almost right away. To take the profit and to secure the profit for this year, because the profits this year for them were, you know, quite good. And any type of news catalyst, especially related to something like tariffs, is going to be that, you know, that trigger for them to sell. And to sell what? To sell the stocks where they have some profits. And I mean, this was a big, quick run of what, about 50% in less than 1 month. So they definitely want to take some profits. Also, you know, technology related. So we saw yesterday a lot of technology stocks being hammered, a lot of momentum stocks are being hammered. Why? Well, because this is where the profits are. So they're taking the profits off the table. That produces that reaction. So I don't know necessarily, you know, whether we should be considering closing the position right here. I think that we should still see how the test develops. The test of this shakeout, is it going to stay here or is it going to go lower and retest the lower lows? So I would probably just, you know, keep it and maybe just even wait for the next test, because if the next test comes and it's, you know, testing correctly, then there might be opportunity to add to this position as well. Francis is asking, is it the backing up of the October-November minor trading range? Yeah, we could definitely, you know, think this way. So we're thinking about this range, sign of strength, and then backing up action starts with the supply. Obviously, yeah, it's a possibility. Yes, Fran, thank you. All right, so I guess we're just skipping it. All right, let's talk about something else. Let's talk about the horizontal volume signature. Again, I'm figuring out how to teach properly volume. Yeah, it kind of sounds funny. It's going to be soon. Soon's going to be 10 years of my teaching, over 20 years of just, you know, studying and trading, and I'm coming up with this statement. I'm figuring out how to teach volume correctly. I think volume needs to be taught with different ways of how we look at volume signature, because in its essence, the volume that we have on the vertical bars, the vertical volume bars, is not very telling. It's actually hiding a lot of the information that we would prefer to have. What exactly? Well, for instance, you know, there's never-ending question about the dark pools. You know, does it obscure our interpretation of the volume, especially for something like ETFs. So that's one of the pieces of information that might be closed. The second and the biggest piece of information is we can't really figure out from the vertical volume bar signature, what was supply level and demand level on that particular bar and where it came from. So these pieces of information are hidden from us, but they could be extracted from other tools. One of these tools is a horizontal volume. Another that I've shown you, a more condensed volume signature on the PNF chart. Another one that I mentioned is cumulative swing signature. Another one, could be, up and down volume. So we'll talk about, those different tools and how they show the volume and so on and so forth. So there are quite a few ways for us to think about volume. Why the horizontal volume is so important is because it shows the levels of support and the resistance, and we anticipate that around those levels, which are based not necessarily on the price, but on the volume signature of the price. This is where we would be expecting some kind of stop in action, because one force is going to be more than another. There are different ways of how this technique is called. I just, for generalization purposes, I call it horizontal volume, so everybody understands instantly what I mean. But there is definitely a market profile, volume profile, a couple of other names, that this technique has. On this chart, you see both the vertical and horizontal volume signatures, and we're first going to look into the yellow square. This yellow square, shows the price of Nasdaq 100 futures. This is a daily chart. And this is the beginning of 2018. That first initial change of character that we had. And horizontal volume signature works extremely well in the trading ranges. Why? Well, because it contains all of the data that is being shown on the daily basis, on the daily charts, as to where the majority of the volume came, at which price level. So therefore, sometimes we call it price on volume, or volume on price, however you're going to call this. And the information from the vertical volume bars is being translated into the horizontal volume signature. By the way, in July, we had a special with Damon Pavlotas, and he was an institutional trader for multiple decades. He created the volume profile signature for TD Ameritrade when it was Thinkorswim. So he has a lot of knowledge about how to construct this, what it means, and so on and so forth. So we had a really good special with him. You could still find that on our website and buy it if you're interested. But I want you to know the basics, because when we look at the vertical chart, I want you to identify where the volume was the highest, and I want you to start anticipating what's going to happen next as the price progresses. So in a way, it's helpful in the trading range. It's also helpful, for the upswings that happen after the downtrend, after the accumulation, because we could recreate a potential structure as to how the price might advance or might decline. All right, well, we'll do that. But first, let's look at this yellow box. And we are seeing that by the end of this box, by the time that the new high has been made, we have this horizontal volume signature. What is it based on? It's based on the levels of the price where we have had the highest volume signature. All right, so something like this as well. And we're going to have those kind of like peaks of where the volume has been, the highest. And what it does, it incorporates not just, one downside, but all of the information that is contained here in the price action. So for instance, this largest bar, we definitely see that there is a lot of volume signature that's coming in on the down bar. Then we've seen that there is some volume signature that's coming in as a temporary stop in action. Then there is a consistent volume signature here. So that all still, kind of like goes into that horizontal volume signature. Then look at this stop in action. Definitely has a lot of both supply and demand. By the way, this is just another example of how quick reaction could be observed. And then next bar as well contains quite a lot of volume right there. Next one. And so we could see that by the time that we are done going through this price level, we could accumulate quite a lot of volume on this level. So our expectation is that when the price comes to that level, let's say this one, or this one, we might have some kind of hesitation, stop, and pausing, just because we know that opposing effort has come and presented itself at this level in the past. All right, well, let's kind of practice now. So we are here, and this is our horizontal volume signature. So what could we expect if we're saying that this bar right here acts as maybe the upthrust and the reversal type of bar, reversing the last commitment to the downside, to the upside, I'm sorry, and then has some kind of test, and then has some kind of confirmatory bar that closes definitely below the big significant bar, and that suggests that we are done with the up move and we are in the downswing. Well, how do we look at the movement in this downswing even prior to the confirmation? So let's say again, we are somewhere here. What would we expect to happen, as the price moves to the downside? We probably would be expecting that we're going to have some kind of stopping at this level. There is both an increase in demand, and by the way, I like when the horizontal volume signature divides, supply and demand like this. I hope that this information is actually accurate. We're still seeing that supply is, would be somewhat dominant at this spot. So we're expecting, good volatility in this area or going into this bar. And then demand could pick up. And we see that there is definitely this demand tail that brings us, slightly up into the close. Hold on a second. Oh, I'm actually, hold on a second, guys. Am I doing this correctly? All right. Okay. Yeah, I think we're. Hold on a second. Let me just double check. All right. Yes. Okay. So we're expecting some demand to come here. We're expecting some demand to come here. So kind of like in this cluster where we would expect some resistance from the demand. And here's that demand coming in. We see this in the vertical bar as well. And it just cannot produce a meaningful rally, so there is still some selling behind it. But this is how we would recognize the support cluster as to where the price could fall and demand could actually increase just because it increased in the past. So where is the next time where demand might increase? Well, somewhere here into this bar. And look what happens at this point. We see that this bar, the spread is slightly diminishing, and the volume, the effort, is slightly increasing. So there is some demand that is hidden in this volume signature, and it's just being shown to us prior to that, prior to the price reaching to that level. And all of this information that we look at has been accumulated on this bar right here. So we are expecting some kind of rally from here. Here is attempt. It's more successful than the previous attempt, so we probably would be thinking that this is the beginning of the stopping action. All right, so you kind of could see how we could even draw the movement of the price based on information that we have. Well, let's try it now without looking at the chart, right? So here is on the right is horizontal volume signature that is being given to us on this last bar. And that includes this whole information, this whole trading range. And that's why, trading ranges are so useful when we use, horizontal volume signature, is because all of the price swings are contained within some kind of structure. All right, well, let's look, let's see what we could extract from this volume signature. We're probably thinking here that this is bullish just because of how effort has increased. There is a stop in action. So this means that demand is present and we're expecting some kind of rally. We are seeing that supply has been absorbed significantly, and now on lower demand signature, on lower effort, the price starts to move up. So here is the time for us to jump into this position, and we want to know how could possibly the price move from this point? Could it move in a specific way, and could we figure out beforehand how it should move? Well, we see on the volume profile that there are some instances when supply is starting to increase, then again, supply is starting to increase, and we want to look at the supply because, this is where some points of resistance are going to come. And then we want to look at the structure and just say, does it make sense that this is where supply might come? All right, so would it make sense if the price rallies and then it meets this supply and then it reacts? Probably it would, because we had the previous attempt to do the same. So we're probably outlining this cluster right here as the first potential move. If this is going to be a sign of strength, we could potentially even overcome that and then come back. And come back where? Come back where the demand started to increase, right? So maybe into this area right here. Or let's say if we're going to just go to this level, then where would demand increase? Somewhere here, we see that demand was increasing. So come back into this area first. Okay, hold on a second. Let me just redraw. Like this, or like this. And this would be the minus sign of strength or a sign of strength. And then from there, up, down, up, down. Again, demand is increasing somewhere here. And then probably overcoming and hitting that resistance. So this is just an approximation of how we could possibly move here, just based on the supply and demand signature. Let's see how we moved. All right, so first we're going to this level of the resistance. This was our clue here, this level. we would experience some increase of the supply. It comes and, like in this instance, has a a rapid deterioration in price and comes to the area where demand started to become active. So we're thinking that it's going to fall into this area. It does. Next time, because it's a bullish bias, and obviously we have to have information here to confirm it, but once it starts to break out, we're thinking, where is the next target for us? Well, we said here supply is going to increase. Stop in action here. And then where would it stop? Well, we saw that there was an increase of demand into this area right here. So we were thinking that it's going to go to this level. Didn't go exactly to that level, just kind of showed more strength. Which was suggestive that maybe this level is going to be not as important, and the price kind of like goes through that level. Again, why is this important? When we select stocks for our portfolio and we look at the character of the next potential move, and we look, let's say, as to how the price could potentially move through these levels, you could select a stock that would suggest that the movement is going to be much easier and faster, where supply is not going to be predominantly, present, and this will allow you to profit more and to have a much enjoyable trade, which is, emotionally might not compromise you. All right. Well, let's see how we understand this concept. So let's do the exercise. A volunteer, maybe? Say yes, and I'll unmute you. And this chart, I'm actually taking from stock charts. So you could create the chart where you see both the vertical bar volume and also the horizontal bar volume. No volunteers? All right. Let's do it. Okay, so we're coming into some kind of formation right here. First of all, let's quickly think about the bias here. What do you think the bias of this formation is? What do you think the bias of this trading range is? Okay. Okay. All right, great. Majority of you are thinking that this is an accumulation. There are a couple of distributional or redistributional patterns. So let's quickly go through this. Increase of the supply and increase of the result suggest a bias to the downside. Continuation of the move. Let's look at how it happens. Momentum, increase of the momentum, and kind of increase in the volume signature. What looks like an attempt to stop here. So this could be a selling climax or preliminary support at this point. What happens after that? After that, kind of like a climactic attempt. Test is not progressing too much, and then some kind of shakeout, and then the next test is at the higher low. Now in between, it has the rally that has the characteristics of buying on the way down and then buying on the way up. So there is definitely some CO buying that happens here. Probably this was value buying as well, attempt to stop. And then into the oversold condition, the price goes down, comes back up really quickly. So acts more like as a spring, and then the higher low acts more like a test, and test happens on diminished volume characteristic. If we would have a commitment below, we probably would be thinking about this in a slightly different way. but we don't have that commitment. Also, look at the rally in between, that yellow rally. Again, I talked about the volume characteristics, but also look at the result. This is the best rally in this whole trading range. So has a lot of bullish characteristics. The last reaction also has a lot of bullish characteristics, and then we are taking off here. So yes, accumulation, we probably would be labeling it like a downsloping range, phase A, selling climax, automatic reaction, secondary test, sign of weakness in B, minus sign of strength in B, phase C, last point of support, and then probably we're in phase D. Okay, so now that we know the biases to the upside, we kind of want to understand, what kind of movement we're going to have to the upside. Our target long term is $90. And we see that the causality here is, somewhat okay, about half a year. So that causality could sustain a move to the 90 and actually above. So we're probably thinking that we're going to hit $100, on that type of move. How would we go there? What would be the path for us with which the price would move? Could we actually figure this out? Well, let's try. So looking at the horizontal volume signature, we are seeing that there is a lot of supply that comes in at around 58.60. So we probably would be expecting, if this is phase C, a break through 60. And then where would we go? Where is supply increasing again? So we have decrease of the supply, we have increase of the supply, we have increase of the supply. So we're probably thinking that the sign of strength could go to this area, 64, 66, and then would come back somewhere. Where would it come back? Probably where demand is increasing, right? So think in terms of movement up, supply is increasing, movement down, demand is increasing. Why do we need to see those increases in supply and demand? Because this is where supply is stopping the price from moving further up, and this is where demand is stopping the price from further moving down. And that's how we are finding the resistance and the support. Please note that, we could have picked maybe 62 as the resistance. We could do that. We could have picked maybe 60 as the support as well. But it's going to be a little bit more accurate if you use the actual price volume on price. Just because this is where supply has occurred, so you are anticipating that that supply and demand is going to be available there. Okay, so let's say that this is the first move. Then what happens next? Well, we are probably after the sign of strength and the backing up action, and we would be thinking, what kind of supply is going to come here. At the lower level, there is quite a lot of supply, so there might be some kind of testing action that we would anticipate. And then after that, there's going to be an attempt to overcome the previous high and go to the next level where supply has increased, right? So we're probably thinking this level right here, 70, 64, 68, and even coming to 72, and then encountering some kind of resistance again. And what are we going to do? Again, we're going to consolidate to the point where we're going to have some kind of increase in demand. In this case, probably I'm thinking like this is the increase in demand, this is increase in demand that we could have. So after, let's say, we're hitting this cluster, we could come to 66, 64. Maybe another attempt to consolidate here. And then the next attempt to overcome 72, 74, and probably come to the next point where supply is going to increase more dramatically, 80, 78, so something like that. Demand is going to increase into this bar, 74, something like that. And then next attempt to go up is 86. Supply is diminishing here, so the movement has to be a little bit better in this area. Not with reactions that are not going to be as substantial as at the beginning, just because the levels of supply here and here, are quite substantial. So it's going to take some time to go through this level. Okay, well, let's see how we did. Okay, so here's our original horizontal volume signature, and this is what has happened after the price has advanced. So you could see how everything changes because there is more data that comes, and that changes the whole horizontal profile. So we're looking into this picture, picture number one. We said that most likely we're going to have the move to above this highs right here, somewhere where supply has increased into 64, 66. Okay, so I would say that we're very close. Then we said that we're going to have some kind of reaction back into 60.58. Okay, that was perfect. And we said that most likely this is going to be a sign of strength because by the structure we know where we are. So we are combining the information from both sources. We are thinking about, well, where is the supply going to come that's going to stop the swing, and what kind of, if this is going to happen, then what kind of labeling we're going to have for that swing. So a sign of strength, a backing up action. We said that supply is probably going to come, so we need some kind of retest. Retest is here, and then we're going to advance to the next level where supply has increased, 70.68. And then we said that probably is going to come back a little bit into this area right here, 66, 64. Didn't go there, suggesting more strength. And then after that, we said that this is the next big level, 72, 74, comes right to that level. And from there, we could have the reaction again into where? Into 66, 64. Somewhere here. Yes, so came there, and then we know that next time it's going to overcome 72, 74. It does so, and then we said that this is where supply is going to start diminishing. So we are expecting the movement with the reactions that are not going to be of the same character, that the reactions are going to be much smaller than what we've had before, just because of what we've seen prior to that. So you kind of could see how this is such a valuable information that we could extract from the volume signature if we're thinking horizontally. If we're thinking vertically, then we will be in the way interpreting the same information only in a different way. So definitely, most definitely, we need to look at horizontal volume signature. Now, the problem with students, and myself including, is that when we look at the horizontal volume signature, we are being distracted. It's a different visual information, and therefore, when we look at it, we sometimes forget about the vertical volume bars. Did you have that switch? Always happens to me for some reason. When I look at the horizontal volume signature, I forget about the vertical. So the key here, I think, is just to look at the vertical and try to find the horizontal volume information in the vertical bars. How would we do that? Well, we want to identify the bars that are going to have the majority of the volume,
those are usually going to be volume spikes. And then you want to project that into the future, and you're going to say, okay, well, at this level, we would be expecting some supply to come in. So if the price moves up into this area, this is where it might have some encounter with the supply, and therefore the price might stop. And then as the price goes further up, you keep doing this. You keep thinking, okay, where is the next level where supply has emerged and was able to move the price in a meaningful way? Here, 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 here. So kind of like the same information. Okay, excuse me, here, 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 and here. So here, here, and here. So this is how quickly, I've constructed this horizontal volume signature. We kind of could see that from the vertical. And when you don't have the horizontal volume signature, that's what you should do. Just think about those levels and think about the price movement, of how the price is going to move. Could be some support here, could overcome this level. If it does, it's going to retest it and then move to the next level, retest it, move to the next level. When supply is going to start diminishing, it's going to move in a different way, in a different character. So I know that a lot of you still having some problems mentally adopting the terminology of the character of the move, because there is not enough definitions there that I gave you guys. Methodology does not necessarily, talks a lot about the character of the next move, but this is something that I want to develop as a knowledge and then as a skill, for our community, because a lot of this will help to define your selection. If you have, let's say, 10 stocks and you only can open 5 positions, and all of the 10 stocks you think that will go up, which ones do you select? Obviously, momentum characteristics might come to mind first, long-term causality for the long-term investors, and so on and so forth. But if you're, regardless whether you're a swing trader or a long-term investor, you would be thinking, how would the price move? Would it move in the accelerated way? Would it have a lot of supply ahead of it? Where is the most beneficial place for me to have some kind of a swing trade? So for instance, if we know that there's going to be a resistance somewhere here and then here, then is this a good place for a swing trade? Or maybe where supply is going to diminish, maybe in this area a swing trade would be better. And we kind of see it from the way how the price moves, right? So more distance where supply is less available, and maybe even a better movement. Although momentum here, is slightly better than, let's say, here, but definitely not here. So that's why analyzing potential character of the move is important, because you're creating a much more efficient trade and you're extracting more profits. And at your level, guys, you should be thinking about those things. And even if you don't apply it, you should still think about this. Please do. Because these are very important concepts, and even if when you look at the stock before you open a position, and when you go through the analysis and you look at, let's say, at the causality, you do the PNF, think about extra question there. How would the price move? Would it move quickly? Would it move with some kind of laborious move, grinding move because supply is available there. Would that benefit your portfolio if the speed, the velocity with which the money is made is lower? Or would you rather have a selection that has that kind of like explosiveness behind it? All right. Let's do this one more time. Here is another exercise. A trading range as well. So let's talk about the bias here. Let's figure out the bias first. What do you think the bias is for this latest trading range, guys?